So I've been receiving a lot of questions of the past few days whether stocks are going to crumble in the new year in January after this very strong post-election rally, or if this is the calm before the storm. So let me walk you guys through a few very specific things here to sort of give you a better idea of what the potential of such a meltdown may be. Number one, let's keep in mind that if we look at the Russell 2000, for example, here, right now we are extremely overbought. Just looking at a simple MACD oscillator, which is kind of giving you an idea of how far an index or a stock or whatever is above or below its moving averages. In this case, you can see that's a record overbought level, which is very simply to say that the rate of change here is unsustainable to the upside. At the same time, though, let's keep in mind that the Russell 2000, as well as the S&P 500, as well as many parts of the market, did accomplish a very important, through the lens of technical analysis, breakout out of what had been a sideways trading range really ever since, as far as the Russell is concerned, probably about early to mid 2015. We had some overshootings, some undershootings, but ultimately, finally now it looks like that breakout looks to be sustainable. Now, it doesn't have to be continue at this rate. In fact, I don't think it will. So that is one argument to make, that maybe at some point in the first quarter of the coming year, we have to see some sort of retracement, maybe even all the way back here. It's not necessarily my base case, but it's something we have to respect also through the lens of technical analysis. That would be about a 7% retracement after the Russell 2000 has now more or less since November rallied about roughly 18%. So about half, giving back roughly half, give or take, of that move back to previous resistance is actually not an inconceivable thing to take place. At the same time, we've seen a rotation from consumer staple stocks into consumer cyclical stocks. If we look at a ratio of consumer discretionary stocks versus consumer staple stocks, that has been a very promising move. But here too, we're getting to what I think is some pretty important technical resistance. So here too, I would think that at least some sort of a pause is quite plausible. Lastly, we can look at things like bond prices, which, in my opinion, are getting extremely oversold. And that doesn't mean they ultimately can't go lower. But if we look at where bond prices are coming to here through the lens of the TLT ETF, they're basically coming right back to the lower end of what had been a multi-year range. Ultimately, yes, this could break lower, but I think the odds here of bond prices continuing lower at this rate are extremely low, which is to say that if they were to bounce, stocks could arguably take a breather, and vice versa. Same thing with the price of gold. As much as I think this doesn't look very good right now, they're getting very oversold, and here too I most likely wouldn't be chasing them lower. So it's conceivable that some of these risk-off assets like gold and bonds will bounce, and that could ultimately be something that will weigh a little bit on equities, and again, vice versa. So to summarize all this, I do not think that stocks have to fall apart in a major way come January or come the first year, but I do think that, for example, if you look at the S&P 500 and we look at the Russell 2000 before, that this rate of change here is extremely unsustainable in the near term, and some sort of a retracement is most likely to take place. It doesn't have to happen on the right when the market opens in the beginning in the new year, but at some point in the first quarter, a retracement back to what used to be resistance, I do think is quite plausible. So chasing stocks higher here, in my opinion, is not a good bet for the near term, although I do think through a 6 to 12 month lens, stocks are well positioned to go higher.